Hello everyone. CoreWeave reported strong revenue, but the stock fell. That matters because the market standard for AI infrastructure stocks is starting to change. Investors are no longer looking only at revenue growth. They are also asking how much money must be spent to create that growth. According to Reuters, CoreWeave's first quarter revenue was $2.08 billion, beating market expectations. On revenue alone, it looked like a strong result. But after the report, the stock fell more than 9% in after-hours trading. The market was not focused only on current revenue. It was looking at the cost structure behind that revenue. The first pressure point is CapEx. CoreWeave raised the lower end of its 2026 capital spending outlook from $30 billion to $31 billion. To expand AI cloud capacity, the company needs to keep spending heavily on data centers, GPUs, power, and equipment. So when demand is strong, growth can increase. But the investment burden can also increase at the same time. The second pressure point is next quarter guidance. CoreWeave gave second quarter revenue guidance, but it came in below market expectations. So even though first quarter revenue was strong, investors became more sensitive to the next stage: growth speed, cost pressure, and execution risk. This does not mean AI demand is weak. CoreWeave's revenue backlog was $99.4 billion at the end of March. Its contracted power capacity also increased by more than 400 megawatts during the first quarter, reaching more than 3.5 gigawatts. Demand is still strong, but the market's question has changed. Is CoreWeave growing? Yes. But the more important question is this: is that growth turning into cash flow that shareholders can actually keep? AI infrastructure companies need more capacity to grow. That means more CapEx, more equipment, more power, and more financing cost. So even when revenue is strong, the stock can fall if investors believe costs are growing faster than the value being created. CoreWeave's decline is not a sign that AI infrastructure demand is over. It is a sign that the market is becoming stricter. Revenue growth alone is no longer enough. Investors now want to know how much more CapEx is needed. Can component costs be passed through to customers? Can backlog convert into revenue and cash flow? And can margins improve while interest expense and operating costs remain high? CoreWeave's results show that AI infrastructure demand is still strong, but they also show that AI infrastructure growth is a fight between the speed of growth and the speed of cost. The key point is not that strong revenue became bad news. The point is that strong revenue was not enough to answer the CapEx and cost questions. The next proof is not revenue growth alone. It is how fast backlog turns into real cash flow.